In 1929, Joseph Kennedy got out 6 months before the crash and made millions shorting the market. In 2008, Michael Burry bet against subprime and made $700 million. In 2025, the same pattern is playing out. Same 4 stages, same investors positioning. Let me show you what they're doing right now that you don't see. There's a pattern in financial history that repeats every time markets reach extreme valuations. It's not random. It's not luck. It's a 4-stage sequence that the same type of investors follow with mechanical precision. While ordinary people hold stocks all the way down, losing everything, a small group positions themselves to profit massively from the collapse. They don't cause the crashes, but they see them coming, and they position to profit from the inevitable. This happened in 1929, when Joseph Kennedy exited at the peak and shorted stocks on the way down. It happened in 2008 when Michael Burry, John Paulson, and others made billions betting against the housing bubble. And it's happening right now in 2025. Warren Buffett is sitting on $325 billion in cash, the largest capital position in market history. Jeff Bezos has sold over $13 billion in Amazon stock. Mark Zuckerberg has dumped billions in Meta shares. Insider selling across corporate America is at levels not seen since 2007, right before the last crash. And a small group of hedge funds are building massive positions that only pay off if markets collapse. This isn't conspiracy, this is documented strategy. The positions are public record, the patterns are historical fact. And once you see how it works, you'll understand exactly where we are in the cycle right now. Let me show you the 4 stages, how they played out in 1929 and 2008, and what the smart money is doing right now. In Stage 3, preparing for Stage 4 when they buy everything at fire sale prices. Stage 1 is exit 12 to 18 months before the crash. This is when sophisticated investors begin liquidating positions while markets are still rising. Not because they know the exact date of the crash, but because they recognize that valuations have reached unsustainable levels and risk outweighs reward. Let me show you how this played out historically and what's happening right now. In 1929, Joseph Kennedy was one of the most successful stock speculators of the Roaring Twenties. He'd made millions running stock pools, coordinated buying schemes that drove prices up so insiders could sell at the top. By the summer of 1929, Kennedy controlled significant positions across multiple stocks, but he started selling. The famous story says he decided to exit after his shoeshine boy gave him stock tips. If shoeshine boys were speculating, Kennedy reasoned, there was nobody left to buy. That's the anecdote. The reality was more calculated. Kennedy understood leverage and forced liquidation. By 1929, margin debt had reached unprecedented levels. Investors were borrowing 90% of stock value to buy more stocks. Kennedy knew that a 10% decline would wipe out leveraged investors, triggering margin calls and forced selling that would cascade into panic. So Kennedy liquidated throughout the summer and early fall of 1929. He wasn't alone. Bernard Baruch, another legendary investor who'd made fortunes in previous panics, was also converting to cash. Baruch had lived through the panic of 1907 and recognized the signs. By September 1929, both Kennedy and Baruch were substantially out of the market. The Dow peaked on September 3rd at 381. The crash began October 24th, Black Thursday, 7 weeks later. Kennedy and Baruch had exited at the top. In 2008, the pattern repeated with different players. Michael Burry ran Cyan Capital, a hedge fund that had been successful investing in undervalued stocks. But in 2005, Burry started researching subprime mortgages. He obtained the loan-level data, the actual characteristics of borrowers whose mortgages were packaged into securities. What he found was shocking. Adjustable rate mortgages given to borrowers who couldn't afford payments once rates reset. Stated income loans where borrowers claimed incomes they didn't have without verification. Loans with teaser rates that would balloon after 2 years. The mortgages were garbage, but they were rated AAA and traded as safe investments. Burr concluded this would collapse, but he couldn't short mortgage-backed securities directly. The instruments didn't exist. So he worked with Goldman Sachs and other investment banks to create a new instrument, credit default swaps on mortgage bonds, essentially insurance that paid out if the bonds defaulted. From 2005 through 2006, Burr bought billions in notional value of credit default swaps. He was paying premiums, losing money every month, while the housing market kept rising. His investors were furious. They thought he'd lost his mind. Some tried to pull their money out, but Burr understood stage 1. Exit the consensus trade and position for collapse before anyone else sees it coming. John Paulson, running Paulson & Company, came to the same conclusion in 2006. He'd studied housing prices relative to incomes and rents. He analyzed mortgage underwriting standards. The bubble was obvious to anyone who actually looked at the data. Paulson launched a fund specifically to bet against subprime mortgages. He raised money from investors, bought credit default swaps, and waited. Like Burr, he endured months of losses and angry investors who questioned the strategy. Both Burr and Paulson were in stage 1 from 2005 to 2007, exiting the consensus long position in housing and real estate stocks, building positions that only paid if the system collapsed. The housing bubble peaked in 2006. Subprime defaults started rising in early 2007. The crash accelerated through 2007 and 2008. Now, let's look at 2025. Who's in stage 1 right now? Start with Warren Buffett. When asked why in the 2024 shareholder letter, Buffett said he can't find anything attractively priced. Translation: everything is overvalued. This is stage 1. Exit while prices are high. But it's not just Buffett. Jeff Bezos has sold over $13 billion in Amazon stock through 2024 and 2025. These aren't small diversification sales. This is systematic liquidation of his core position. Mark Zuckerberg has sold billions in Meta stock, even as the stock hit new highs. Jamie Dimon, CEO of JP Morgan Chase, sold shares for the first time in his tenure as CEO. Insider selling across corporate America has reached levels not seen since 2007, right before the financial crisis. Company executives have access to information ordinary investors don't. They see the real earnings, the real customer pipeline, the real problems, before they show up in quarterly reports. And they're selling. This is the ultimate signal. The people running these companies don't believe current valuations are sustainable. The Buffett indicator, which divides total stock market capitalization by GDP, sits at 185%. Buffett himself has said that anything over 120% indicates dangerous overvaluation. At 185%, the signal couldn't be clearer. He's not just cautious, he's preparing for collapse. This is stage 1 playing out right now. The smart money is exiting. Not all at once, because that would crash the market prematurely, but systematically over 12 to 18 months. While retail investors buy the dip and believe in artificial intelligence as the next revolution, the people who actually run these companies are selling to them. When the world's most successful investors are holding record amounts of cash and selling stocks in companies they know intimately, they're telling you something. Stage 1 is complete. The smart money is out. Stage 2 is buy volatility insurance 6 to 12 months before the crash. This is when sophisticated investors don't just exit long positions. They buy protection that pays if markets fall. In modern markets, this means buying put options, VIX calls, or credit default swaps. The key is that stage 2 happens before the crash is obvious, before most people are worried, when volatility is low and insurance is cheap. Let me show you how this worked historically and what's happening now. In 1929, the equivalent of volatility insurance was shorting stocks. After Kennedy and Baruch exited their long positions, they began building short positions. Shorting means borrowing shares, selling them at current prices, and hoping to buy them back cheaper later. If you short a stock at $100 and it falls to $50, you make $50 per share. Kennedy established short positions in multiple stocks through the summer and early fall of 1929. He was paying borrowing costs, a form of premium, while stocks kept rising. But he understood that when the crash came, these positions would explode in value. The crash began October 24th, Black Thursday. By the end of October, stocks were down 30%. By November, down 50%. Within 3 years, the market fell 89% from peak to trough. Kennedy's short positions made millions. The exact figures aren't public because disclosure requirements didn't exist then, but estimates based on his known wealth accumulation suggest Kennedy made between $15 and $50 million from shorting. That's equivalent to several hundred million today. This is stage 2 paying off. He'd bought insurance, paid premiums, while the market rose, and collected massively when it crashed. In 2008, Burry and Paulson's credit default swaps were stage 2 instruments. From 2005 to 2007, they paid premiums every month. The swaps cost roughly 2 to 4% annually on the notional amount insured. If you bought $100 million in insurance, you paid $2 to $4 million per year with no payout if mortgages didn't default. For 2 years, Burry and Paulson paid these premiums and watched the housing market keep rising. Their investors revolted. Some tried to force redemptions, wanting their money back before Burry lost it all. Burry had to lock up the fund to prevent investor panic, but he understood stage 2. You pay for insurance when it's cheap, before the disaster is obvious. In 2007, subprime defaults started rising. By early 2008, major financial institutions were reporting massive losses. Bear Stearns collapsed in March 2008, sold to J.P. Morgan in a government-arranged fire sale. Lehman Brothers filed for bankruptcy in September 2008, the largest bankruptcy in American history, and the credit default swaps exploded in value. Contracts Burry bought for a few million in premiums paid out hundreds of millions when the underlying bonds defaulted. Paulson's fund, which bought tens of billions in notional insurance, collected $15 billion when it paid out. The premiums they paid for 2 years were irrelevant compared to the payout. Bill Ackman executed a perfect stage 2 in March 2020. When COVID hit and markets started falling, Ackman bought credit default swaps on investment-grade corporate bonds. He spent $27 million on this insurance. Within weeks, as panic accelerated and markets crashed 35%, those swaps paid out $2,600 million. That's a 96-to-1 return in less than a month. Ackman then immediately used that cash to buy stocks at the bottom, which we'll discuss in stage 4. But the point is stage 2. He bought insurance at exactly the right moment, and it paid off massively. Now let's look at what's happening in 2025. Volatility insurance comes in several forms. Put options, which give the holder the right to sell stocks at a predetermined price. VIX options, which bet on volatility spiking, credit default swaps on corporate bonds or mortgage securities, and the activity in these markets is surging. The put-call ratio, which measures the volume of put options relative to call options, has been elevated through 2024 and 2025. This ratio normally sits around 6 to 8. When it rises above 1, it indicates more puts than calls are being bought. More investors buying insurance than buying speculative upside bets. The ratio has been persistently elevated, indicating institutional hedging. VIX call options, which profit when volatility spikes, have seen unusual activity. Large institutional purchases of VIX calls expiring in mid-2025 and late 2025. These are bets that markets will crash during that window. The positions are large enough, tens of millions in premium, that they can't be retail traders gambling. These are institutions buying insurance. They're paying premiums now, expecting a massive payout later. Credit default swaps on commercial mortgage-backed securities have spiked in price. The cost to insure against defaults in commercial real estate has increased 300 to 500% since 2021. This tells you that sophisticated investors believe commercial real estate will collapse, and these swaps will pay out massively. Someone is paying these elevated premiums because they've done the math. Office buildings sitting 40 to 50% vacant, mortgages coming due that can't be refinanced at current interest rates. Defaults are inevitable. And when they happen, these credit default swaps will explode in value, just like the subprime swaps did in 2008. Bill Ackman publicly discussed buying protection in 2024. In interviews and investor letters, Ackman said he is considering hedges similar to what he did in March 2020 because he sees risks in commercial real estate and regional banks. He hasn't disclosed the exact positions because hedge funds don't have to, but the fact that he's talking about it publicly tells you he's already positioned. This is stage 2. Buying insurance before the crash is obvious. Paying premiums while markets still feel stable and waiting for the inevitable payout. Stage 3 is short specific sectors, 3 to 6 months before the crash. This is the most aggressive stage. It's not just holding cash or buying insurance. It's actively betting against specific industries or companies that are the most vulnerable. Stage 3 requires precision. You're not just shorting the market generally. You're identifying exactly which sectors will collapse first and positioning accordingly. In 2008, Stage 3 was where Burry, Paulson, and others made the biggest money. They weren't just betting against housing generally. They identified specific tranches of specific mortgage bonds that were most likely to default. Burry analyzed loan-level data and found the worst mortgages. Subprime loans in Florida, California, Arizona, and Nevada, where speculation was most extreme. Adjustable rate mortgages resetting in 2007 and 2008 when borrowers couldn't afford the new payments. He shorted those specific bonds. When defaults hit, those bonds went to zero. Burry's credit default swaps paid out at maximum value. Paulson did the same with mortgage bonds, but he also shorted specific financial companies. In 2007 and early 2008, before it was obvious these firms would fail, Paulson shorted Lehman Brothers, Bear Stearns, and Washington Mutual. These were not popular trades. Wall Street analysts rated these stocks as buys or strong buys. The consensus was that these firms were too big to fail, that the government would never let major financial institutions collapse. But Paulson saw their exposure to subprime mortgages. He knew they were insolvent. Their assets, the mortgage-backed securities, were worth far less than the liabilities, the money they owed to creditors and depositors. When Bear Stearns collapsed in March 2008, Paulson made a fortune on that short position alone. The stock went from over $100 to $2 in a matter of weeks. When Lehman filed for bankruptcy in September 28th, another massive payout. The stock went to zero. Shareholders wiped out. But Paulson, who was short, made billions. His fund's total returns from 2007 to 2009 were approximately $28 billion across all strategies. Most of that came from Stage 3, shorting specific companies and bonds that were most exposed. Now, let's examine what's being shorted in 2025. The two sectors flashing maximum vulnerability are commercial real estate and regional banks. And the smart money is building massive short positions in both. Commercial real estate has entered a death spiral that most people don't understand yet. Office buildings across America sit 40 to 50% vacant due to permanent remote work. Companies that used to lease 5 floors now lease 2. This isn't temporary. Remote and hybrid work are permanent changes to how corporate America operates. These buildings were financed with mortgages at 3% interest rates when money was cheap. Those mortgages are now maturing and need to be refinanced, but current interest rates are 7 to 9%. That's triple the interest rate. A building that barely generated enough rental income to cover debt service at 3% interest is bankrupt at 8% interest. The math doesn't work. Building values have dropped 40 to 60% in many markets because buyers understand the properties can't support the debt at current rates. When these mortgages can't be refinanced, the owners will default. They'll hand the keys to the lender and walk away. This has already begun. Brookfield Asset Management, one of the world's largest real estate owners, defaulted on 2 Los Angeles office towers in 2024. Just walked away, stopped making payments, gave the buildings to the lender. This wasn't because Brookfield is in financial trouble. It's because those specific buildings are worth less than the mortgages. It's economically rational to default. Over $2 trillion in commercial mortgages come due during 2285 and 2026, a significant portion that won't be refinanced. Defaults will cascade, and the lenders holding those mortgages, primarily regional banks, will realize massive losses. Hedge funds have built short positions in commercial mortgage-backed securities. These are the same types of securities that collapsed in 2008, except instead of residential mortgages, they're backed by commercial property loans. The credit default swaps on these securities have spiked in price because everyone sees this coming. When the defaults accelerate through 2025 and 2026, these shorts will pay off massively. Regional banks are the second target, and this is where Stage 3 gets really interesting, because we've already seen the preview. Silicon Valley Bank collapsed in March 2023, in the second largest bank failure in American history. Signature Bank failed the same week. First Republic Bank failed in May 2023. Sold to JP Morgan at a huge loss to the FDIC. New York Community Bank nearly failed in early 2024, saved only by emergency capital injection. These failures happened even though we weren't in a recession yet. They failed because they held long-term bonds and mortgages that lost value when interest rates rose rapidly in 2022 and 2023. But the bigger issue is commercial real estate exposure. Regional banks are the primary lenders for commercial real estate. The big banks, JP Morgan, Bank of America, Wells Fargo, they have some commercial real estate loans, but it's a small percentage of their portfolio. Regional banks have massive exposure. 20, 30, sometimes 40% of their loan book is commercial real estate. When those loans start defaulting, when office buildings are worth half of the loan amount, the banks have to recognize losses. Those losses eat through the bank's capital. When capital falls below regulatory minimums, regulators close the bank. Short sellers have identified the specific regional banks with the most commercial real estate exposure. This information is public. Banks disclose their loan composition in quarterly reports. You can see which banks have the highest concentration in CRA loans, which banks are in markets with the worst office vacancy rates. San Francisco, New York, Chicago, Los Angeles. Short interest in these banks. The percentage of shares that have been sold short has spiked. Major hedge funds are betting these banks will fail. Some regulators and politicians argue that short selling is predatory, that it causes bank runs through spreading fear. But that's backwards causation. The banks are insolvent because of bad loans. Short sellers are just recognizing reality before regulators admit it publicly. This is Stage 3 playing out right now. Precision targeting, not shorting the entire market, which is expensive and imprecise, but identifying the specific sectors, specific companies, specific securities that will collapse first and hardest. The smart money is in Stage 3. They've built short positions in commercial real estate securities and regional banks. They're paying borrowing costs to maintain these shorts, and they're waiting for the collapse that will make these positions explode in value. When commercial real estate defaults cascade in late 2025 and 2026, when regional banks start failing in clusters, Stage 3 will pay off just like it did for Paulson and Burry in 2008. Stage 4 is buy at maximum fear. This is the culmination, the stage where the previous 3 stages pay off, and the smart money deploys capital to buy assets at fire sale prices. Stage 4 happens at the bottom, when panic is greatest, when everyone else is selling, when it feels like the world is ending. This requires psychological fortitude that most people don't have, and massive cash reserves built in Stage 1. Let me show you how this has worked historically, and what it will look like when it arrives. In 1929, the crash was brutal and prolonged. The market didn't just fall and recover. It fell 89% from peak to trough, from 381 in September 1929 to 41 in July 1932. Almost 3 years of continuous decline. Most investors were completely wiped out. They held stocks all the way down, hoping for recovery that didn't come for decades. But Kennedy, Baruch, and the others who'd executed stages 1 through 3 were ready for Stage 4. Kennedy deployed his cash to buy stocks and real estate at depression prices. He bought distressed properties from owners being foreclosed. He bought businesses being liquidated at auction. He bought stocks trading for less than the cash on their balance sheets, companies that were fundamentally sound but whose stock prices had collapsed in the panic. By the mid-1930s, Kennedy was one of the wealthiest men in America. His fortune had multiplied while everyone else lost everything. Stage 1 exit and Stage 2 and 3 shorts had made him money. But Stage 4, buying at the absolute bottom, created generational wealth that would fund the Kennedy political dynasty for generations. In 2008, Stage 4 happened faster than 1929, but followed the same pattern. The market bottomed in March 2009. The S&P 500 hit 666, down 57% from the peak. Fear was absolute. Every day brought news of more bank failures, more layoffs, more foreclosures. Headlines predicted another Great Depression. Economists said we might never recover. But this was precisely the moment the smart money deployed. Warren Buffett made several massive investments during the crisis that have become legendary. In September 2008, at the absolute peak of panic, when Lehman had just failed and the government was bailing out AIG, and nobody knew if the financial system would survive the weekend, Buffett invested $5 billion in Goldman Sachs. He bought preferred shares, paying a 10% annual dividend plus warrants to buy common stock at a favorable price. It was an incredible deal. Goldman desperately needed capital. Nobody else would provide it because everyone was terrified. Buffett stepped in and got terms that virtually guaranteed profit. He made a similar investment in Bank of America in 2011, when that bank was still facing crisis from mortgage losses. $5 billion in preferred shares plus warrants. These investments alone made Berkshire Hathaway tens of billions of dollars. Goldman Sachs made Berkshire over $3 billion in profit just from that one investment. But the real gains came from buying stocks generally at the bottom. Berkshire increased its positions in Wells Fargo, American Express, U.S. Bank, and other quality companies during the crisis. Those investments tripled and quadrupled over the next decade. Bill Ackman executed what might be the most perfect Stage 4 in history. In March 2020, as I mentioned, he bought credit default swaps that paid out $2,600 million on a $27 million investment. But here's what makes it Stage 4 perfection. A man went on CNBC on March 18, 2020, and gave an apocalyptic interview. He said, "Hell is coming, that the economy is collapsing, that millions will die, that capitalism itself is at risk." It was terrifying. The market crashed even harder after his interview. But here's what he didn't say on TV. While he was on CNBC predicting doom, his fund was simultaneously buying stocks with the cash from the credit default swap payout. He bought stocks he knew were fundamentally sound but had been destroyed by panic selling. Starbucks, Hilton, Lowe's, restaurant brands, companies that would recover when the panic ended. Within 3 months, the Federal Reserve and government intervened with unlimited stimulus. Markets recovered in the fastest rebound in history. Ackman's fund had its best year ever, making billions. He made money on the way down from volatility insurance in Stage 2, then made even more money on the way up from buying at the bottom in Stage 4. That's the pattern executed perfectly. Now let's talk about what Stage 4 will look like in 2025 and 2026. The crash hasn't happened yet. We're in Stage 3, waiting for the trigger. But we can predict how Stage 4 will play out based on the historical pattern. When the crash comes, whether triggered by commercial real estate defaults cascading, a major tech stock collapse, a geopolitical crisis, or something else, panic will be severe. Markets could easily fall 50 to 60%, maybe more if it's worse than 2008, as many indicators suggest it could be. Unemployment will spike from current 4% to potentially 12 or 15%. Regional banks will fail in clusters. The media will run 24-hour coverage of economic collapse. Politicians will demand action. The Federal Reserve will face impossible choices. That chaos, that maximum fear, that's when Stage 4 happens. Buffett's $325 billion in cash isn't sitting idle for no reason. He's waiting for exactly this moment. When the S&P 500 is down 50% from current levels, when stocks he wants to own are trading at valuations he hasn't seen in decades. That's when he'll deploy. He'll make investments similar to his Goldman Sachs deal in 2008. Preferred shares with high dividends, plus warrants in companies desperate for capital. He'll buy stocks outright in quality companies whose prices collapsed. He'll potentially buy entire companies. And because he'll be one of the few with massive capital available, he'll dictate terms that are extremely favorable. This is how billionaires become much richer during crashes. Not because they're predatory, because they have cash when nobody else does, and they're willing to deploy it when everyone else is paralyzed by fear. Private equity firms have raised record amounts of capital in recent years, specifically for this moment. Apollo Global Management, KKR, Blackstone, and Carlyle Group, they're all sitting on hundreds of billions in what's called dry powder, capital that's been raised from investors but not yet deployed. This isn't money they're planning to deploy at today's prices. It's money being held specifically for Stage 4. When the crash comes, when commercial real estate has defaulted and owners are desperate to sell, these firms will buy buildings at 30 to 50 cents on the dollar. They'll buy distressed corporate debt. They'll buy foreclosed residential properties by the thousands. And they'll hold these assets for 5 to 10 years while they appreciate back to normal valuations. The four-stage pattern isn't magic. It's not insider information. It's a framework that is repeated throughout financial history because it's based on human psychology and market mechanics. Bubbles always burst. Leverage always unwinds. Panic always creates opportunities. And the investors who understand this, who have the capital and psychological discipline to execute all four stages, they profit massively, while everyone else loses everything. You're seeing this pattern play out right now in 2025. Stage 1 is complete. The smart money has exited. Buffett, Bezos, Zuckerberg, corporate insiders, they've sold billions at peak prices. Stage 2 is ongoing. Volatility insurance is being bought. Put options, VIX calls, credit default swaps on commercial mortgages. Premiums are being paid in preparation for the payout. Stage 3 is being established right now. Short positions in commercial real estate securities and regional banks are being built by hedge funds who see the inevitable collapse coming. And Stage 4 is waiting. The massive capital reserves are ready to deploy at maximum fear. The question for you isn't whether this pattern will play out. History says it will. The question is whether you'll recognize it and position accordingly. Most people can't execute all four stages. They don't have the capital, the knowledge, or the psychological discipline. But understanding where we are in the pattern gives you an enormous advantage. We are in late Stage 3 right now. The crash hasn't happened yet. but every indicator says it's coming within 6 to 18 months. The yield curve inverted and has normalized. That signal has predicted every recession since 1950. Buffett's indicator is at 185% versus his stated danger threshold of 120%. Commercial real estate is defaulting. Regional banks are failing. Insider selling matches 2007 levels. If you can't execute stages 1 through 3 professionally, you can still prepare for stage 4. Hold more cash than you normally would. 20, 30, even 40% of your portfolio in cash or short-term treasury bills. Yes, you might miss some gains if markets continue rising, but you'll have capital to deploy when the crash comes. And buying stocks when they are down 50 to 60% will generate far more wealth than holding through the decline and losing that capital. Consider buying some protection. Put options on SPY, the S&P 500 ETF, aren't complicated. Buy puts expiring in 6 to 12 months at strike prices 10 to 20% below current levels. You'll pay maybe 1 to 3% of your portfolio value. If markets crash, those puts could return 5 to 10 times what you paid. If markets don't crash, you lose the premium. But that's what insurance is. You pay for protection, hoping you never need it. Most importantly, when stage 4 arrives, when markets are down 50%, when unemployment is spiking, when banks are failing, when everyone around you is terrified and the media predicts the end of capitalism, have a list ready. A list of quality companies you want to own. Companies with strong balance sheets, low debt, products people will always need. These companies will be on sale at prices you'll never see again in your lifetime. The fear will make it feel impossible to buy. Every emotional signal will scream, "Wait, it's going to get worse." Ignore those signals. That's stage 4, and buying at stage 4 at maximum fear has created more wealth than any other investment strategy in history. The 4 stages have played out twice in the last century, 1929 and 2008. They're playing out again right now. The same pattern, the same sequence. And stage 4, the buying opportunity of a lifetime, is coming. Whether you're ready for it, whether you have the capital and courage to act when everyone else is paralyzed, that will determine whether you're one of the few who profits from the next crash, or one of the many who loses everything. The pattern is clear. The stages are documented, and we're in stage 3 right now, waiting for the inevitable. The smart money knows this.